Hello, and welcome to the Investing on the Go podcast. I'm Juliet Schooling-Latter, and today I'm joined by Brendan Gulston, co-manager of Gresham House UK Multi-Cap Income. Hi, Brendan.
Hi, Juliet.
Last year was awful for dividends. Your target yield on the fund is 4%. How did it hold up? And I wondered what your thoughts were on the outlook for dividends this year.
Yeah, last year was clearly a tough year for UK dividends. If you look across the entire UK equity market, then you'll see that the dividends fell 44%, and 2/3 of companies either cut or cancelled dividends between the second quarter and the fourth quarter of last year. Amongst that picture, the hardest hit sectors were banks, oil and gas, mining, and consumer discretionary sectors, which may not come as a big surprise. And it's also worth mentioning that UK dividends did fall within every quarter of last year. If you look across the entire UK market, so the picture, as you alluded to, was quite bleak. If you look at our portfolio, the income fund fared really strongly against that backdrop. So if you look at the headline figure against a 44% decline, our dividend level declined, but it only declined by 17%. I think what was sort of more interesting really is that if you look at the quarterly breakdown of how our fund was impacted, you look at the second quarter of the year, clearly when the pandemic was basically in full force, our fund was our year-on-year income for the fund was down, not down as much as the wider UK sector, but nevertheless it was down fairly heavily. But in Q3, our dividend amount actually grew year-on-year by 17% compared to a decline of almost 50% for the market. And what's interesting about that is that it's really consistent with the resilience of the portfolio companies that we have in the fund, and it demonstrates what we've been kind of talking about in terms of the types of businesses that we look for and the type of income streams that we target. Because whilst the headline picture looks kind of negative overall for UK equities, actually, within the portfolio, we saw a number of companies which were impacted by the pandemic and which sort of paused dividends. But for the most part, those sort of dividends were paused really out of prudence as they sort of started to work through what the picture was for their business, for the wider economy. And we, subsequently we saw many businesses sort of implement cost cutting and actually emerge really trading quite strongly out of the pandemic in Q3 and Q4. And the metric that we looked at across our portfolio was that actually 80% of the businesses saw uninterrupted income streams. So we had a cohort which was basically completely unaffected. But as I said, there was a sort of smaller cohort where they did pause dividends or cut dividends temporarily, but the nature of those businesses and the nature of the fundamentals and the markets that they operate in allowed them to sort of resume dividends towards the end of the year. So all in all, if you look at that from a fund perspective, as I said, our dividends were down last year versus 2019, but we hit a dividend yield of 3.3% for the year. This year, we're targeting, back in line with our target of a 4% yield.
That's good news for your investors. As a team, you tend to avoid cyclical companies, which are ones dependent on the health of the economy. Do you think that could be a barrier to the performance of the fund as this year progresses and everything reopens? Or will your bias towards small and mid-cap companies counterbalance that?
So you're right. We tend to avoid what I would call overly cyclical sectors or areas where external factors can heavily influence the investment case and can really determine whether a company or a business succeeds or fails. Some examples of those are the banking sector, oil and gas, and the mining sector. For example, within oil and gas and mining, the commodity prices have such a big effect on earnings and dividends and cash flows that those are outside of the control of the management team, and we feel that those are kind of too reliant on external factors, and therefore the risk-return balance doesn't work for us. So we've not participated in those sectors historically. But I think the important thing is that there's sort of three important points to make. The first is we don't think that's a material headwind to us because we've got a very large investment universe. So we invest across the market cap spectrum, where there's over 1,000 companies that we can invest into, and we're not kind of pigeonholed by only being able to focus on certain size of companies, for example. So this sort of active exclusion is because it's to do with how we're targeting some long-term risk-adjusted returns, and we see that as being a key driver of our risk mitigation process. So it's worth reiterating that there are plenty of opportunities out there, and we've got the platform, we've got the expertise in small cap, we've got the private equity network to be able to really diligence the entire space, the entire market cap spectrum. So I don't think from a kind of from an opportunity perspective, we're going to be sort of struggling to find things to invest in.
Now, I note you have an insurance company and an actuarial company in your top 10. These are often professions that are thought of as rather boring. What makes these companies interesting investments?
Well, often I've found that it's the kind of relatively boring businesses that can make actually quite attractive and quite exciting investments. But let me take these businesses in turn. So the actuarial consulting business is a company called XPS, and the reason it's a pensions consultancy business, and it also does sort of administration services for pensions as well. And the reason why it's interesting is because, firstly, the market dynamics are really attractive. So the pensions consultancy market has historically been dominated by some very large insurance companies like Willis and Aon. Essentially what XPS is doing is their client is the sort of board of trustees for large defined benefit pension schemes, and they're providing them with advice and consultancy services around those schemes. And so that market has sort of been dominated by much bigger players who don't just do pensions consultancy; they do a wide range of insurance services. And why XPS is interesting is because it focuses just on providing that type of advice to these clients, and it's not, it doesn't have distractions in terms of other sort of business lines that it's focusing on. So we believe that creates an opportunity to sort of provide kind of much more specialist and complex advice, and that is a barrier to entry, and that is a core part of the value proposition. And we've seen them to displace kind of, in terms of displacing some of the larger players on services work. We've seen that happen over the past few years. The other interesting points to know about the market are that it's obviously a very technical market, and there's a lot of complexity, and there's quite a bit of regulation change that is driving the kind of demand from customers. So I suppose the other point worth noting is just that the quality of earnings is quite visible for this business as well. So typically some of the work is sort of happens over a kind of periodic, has to happen ever so often. in order to meet kind of various, to meet various targets for valuation targets or whatever it is. But the way that the company looks at their earnings stream is really from a kind of monthly billing perspective, and they typically deem their revenue to be sort of repeat or almost recurring if it's 24 months of consecutive billing. And that was historically it's been over 80% of their revenue. So the quality of earnings, we believe, is quite attractive as well. And then you mentioned the insurance business too. That one is Randall and Quilter, which is it's a specialist insurance business. It's quite an exciting combination of both income and capital growth. So again, it's probably, it might sound quite boring, but it's sort of technical and quite niche. And, that was where we saw a real opportunity. And, we thought if we can really get into the detail of the business and understand what the value proposition is and kind of where the income streams are coming from and what the sort of growth trajectories are, then this could be a really attractive investment. And so we spent the time really doing quite a lot of diligence on the business and referencing the team and the business itself. They have one part of their business which is a legacy acquisitions business, which basically it buys legacy liability books off corporates that don't want to have the kind of have to provide on their balance sheet, multi-millions of pounds for a kind of legacy liability that's non-core to their business. And Randall and Quilter take that off their balance sheet and they manage it for them. And, that's a business that's been operating for about 30 years and they've got a really solid track record and reputation in that market. And then they've sort of leveraged their insurance expertise to they launched another part of the business, which is a program management business in the US, where which is really the real growth driver. It's in the US and Europe. It's the real growth driver of the business, and we felt that the market wasn't really ascribing much value to that growth business. So it's an attractive combination of income and capital growth.
And I also have to ask about your holding in Strix, a supplier of kettle safety controls. How on earth do you find a company like that?
Yeah, so I don't think anyone would seek to find a company like that, really. It is, you're right, it's very niche. It is the global market leader in the manufacturing and distribution of kettle controls. And the business, so we've been invested in Strix since it IPO'd in August 2017. It IPO'd at £1 a share, and it's now sort of trading at £2.76 a share. And when it listed it, it listed at a really attractive valuation multiple and an attractive dividend yield. From memory, the price earnings multiple was high single digits and the dividend yield was pretty similar to that. So it was attractively priced. And, it doesn't sound like a particularly exciting business, but ultimately our investment judgment on Strix was that it's got a really strong market share in a niche market with high barriers to entry. So I suppose how do you come across a business like that? To answer your question, we're very plugged into the broker and advisor network, across the market cap spectrum, but particularly given our sort of small and mid cap heritage, we do see a large number of IPOs and fundraisings. But I think what was the sort of critical catalyst for us was that Strix was owned by a variety of private equity houses, and we were able to specifically reference with one of the investor directors from the private equity house that was exiting the business and who sat on the board for a number of years. We were able to speak to him directly through our network and to really test that critical judgment around, what's the sustainability of the long-term income? What value would you be ascribing to growth, if any? And how protected are the profits over the long term, and that was a crucial bit of diligence for us, because we came out of that with the view that this may grow, but it's not essential to grow, but the profit streams are really well protected by the market position and by a number of other factors that we learned about the business. And since IPO, we've been sort of proved wrong in terms of the capital growth, because as you've seen, the shares have almost tripled. So that they have managed not only to deliver a sustainable yield, but also to find capital growth opportunities. So I suppose that has been quite a positive surprise for us.
Finally, I noticed that since October, Gresham House Energy Storage has been added to your top 10. Is this on the back of the UK building back better and greener? Is there a trend you are playing here? And are there any other linked holdings in the fund?
So I wouldn't say it's specifically off the back of the UK build back better and greener. So Gresham House Energy Storage Fund effectively is the energy storage sites that connect into the national grid. Some battery storage facilities that allow energy supply and demand to be adequately balanced by taking power off the grid and then pushing it back onto the grid. So it wasn't specifically due to that initiative. We have been invested in that business for a longer period of time. We participated in the fundraising last year and added to our position. What we saw as really exciting with that business was the overall trend. So, the market trend, which we saw as being this convergence in terms of a shift to renewable energy sources, combined with the kind of overarching strategic government ESG initiatives that were sort of starting to play out. What we thought was really interesting was that, we looked at the UK energy market, and the proportion of the UK energy market that's coming from renewables is rising dramatically. And there's this sort of longer term kind of transformational shift towards more flexible power generation, whereas in the past it was reliant on coal and oil and gas and a much more kind of stable power generation model. And this shift to renewables, what it does is it increases the volatility of supply, because clearly renewable energy can't really be switched on and off as easily. So you have higher variability and you have a higher need to balance supply and demand on the national grid. So we saw that as just being a really long-term structural growth opportunity and a structural trend that would kind of transform the industry. What we liked about the Gresham House Energy Storage Fund as well was that it had a really great market position. It was an early mover and it was growing really rapidly. And the last sort of meeting I had with them towards the end of last year, they had sort of 25% of the market share in the UK. They'd rapidly sort of either built out or acquired sites across the UK, which are in strategic locations where you can plug into the national grid. A bit like the electric vehicle charging stations, where you'll have seen there's a number of companies that are kind of buying up access to power supplies to then set up these electric vehicle charging stations because they think there'll be kind of strategic value in those sites. So we thought it was a really exciting sort of market position and growth story as well. And from a fund perspective, the yield's really attractive. There's a 7% yield target initially. Plus, there's also this capital growth potential from an unwind in the discount rate, which basically causes the value of the assets of the projects to increase over time. And as we've seen more interest in the sector, more players come into the sector, these assets are becoming sort of more valuable. The discount rate is decreasing, and so it's a good mixture of both of those elements for the fund. And I suppose to answer the second part of your question, it does, in terms of other, it does play into a broader ESG trend where we're seeing really long-term structural growth opportunities.
Interesting stuff. Brendan, thank you so much for your time today.
Thank you.
If you'd like more information about Gresham House UK multi-cap income, please visit fundcalibre.com and don't forget to subscribe to the Investing on the Go podcast. Please note that these are unprecedented times and markets can react very quickly to news. The views expressed are at the time of recording and could change. And remember, we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these stocks at the time of listening.